Meantime, our first guest this morning believes the bank may now be done with rate hikes, with increasing signs that Canada is in a recession. Frances Donald is global chief economist and strategist at Manulife Investment Management, and she joins us. Frances, great to see you. Thanks very much for your time.
Thanks for having me.
So, your takeaways from the Bank of Canada decision, firstly, yesterday.
This is the Bank of Canada that is done hiking interest rates, but they can't tell us that. They can't get our hopes up, because if the market or if Canadians begin to believe that there are no possibility of future rate hikes, or worse, that rate cuts are around the corner, then inflation expectations might start to rise again, that housing market might start to get inflamed, you would see the bond market beginning to lower some of the embedded interest rate predictions. That's not what the Bank of Canada needs right now as it continues to fight inflation. But the Bank of Canada is done hiking interest rates. They will probably be cutting in early 2024. They're just not going to blink on that until they absolutely have to.
And it was interesting earlier this year, Frances, when the Bank of Canada had hit the pause button, and then it seemed like our housing market got back into its active ways. And that might speak to some of what you're alluding to, the psychology of rate hikes or the messaging around rate hikes. I mentioned that contraction, though, ultimately, that we saw in the second quarter for Canada's economy. What are you looking at? What economic data points are you looking at that would signal to you that the bank is done with rate hikes?
I'm fairly surprised at how loose and easy everybody is with this contraction in GDP. You might remember a recession is 2 quarters of negative GDP. We're halfway through that technical definition of a recession, and most indicators, from jobs to credit activity to sentiment, suggest that next quarter, Q3, where we are right now, is worse than last quarter. So the odds of a recession are substantially higher. And that's really the big difference between the first pause that we saw and the pause that we're in now. Now, not only is Canada most likely in a recession, but if you look south to our American neighbors, their unemployment rate is now climbing. They have a very sharp contraction in credit activity. China's economy is slowing, and Europe is absolutely in a recession. So this is a different environment now in September than it was in the last pause. And this is one of the reasons why the Bank of Canada will probably be done. But again, they won't tell us they're done until they absolutely have to.
And what about on the inflation front itself? What are you measuring there? One piece of data that people have been chattering about is oil prices recently, for example. And they say, aha, here's another example that this fight against various forms of price pressures is going to continue. How do you feel about where inflation goes from here?
Well, this is the big challenge, and we've been talking about this for a couple of years now. There's inflation that our Bank of Canada can fight, inflation in the housing market, inflation in services activity, what Canadians spend in their day-to-day on services, and there's inflation the Bank of Canada can't directly fight, and that's going to be oil and gasoline. Oil and gasoline are determined by global supply and demand factors. So if the Bank of Canada tells us, well, it might hike interest rates because inflation will come up on gasoline prices, what they're really saying to you is that they're going to create deflation and more pain in the economy, not to solve gas prices, but to really push down prices in other areas so that on average we end up closer to 2%. This is the big fight for the Bank of Canada and all central bankers. The economies are now starting to weaken fairly substantially in Canada, but inflation is not solved. And so it's going to be much more difficult for central bankers moving forward to really commit very dedicatedly to this 2% target. They're going to have to make a choice. How deep of a recession do they want to go versus do they really want to get to 2%, or will 2.5% be okay?
And speaking of choices, if we are at the end of the rate hike cycle, I guess some people wonder, what is the determining factor for whether or not interest rates at some point come down? How are you going to watch that story heading into 2024?
I suspect, like all economies, it's going to come down to jobs. We've lost jobs in Canada 2 of the last 3 months. Tomorrow's job indicator is going to be very important, and the Bank of Canada is going to want to see those wage numbers come down. I strongly suspect that it's going to be jobs, labor, wages, and the Canadian consumer that's going to end up breaking the Bank of Canada towards easing as opposed to inflation, because we're probably not going to be back to 2% inflation by the time this economy really needs lower rates. This is a new paradigm for central banks. And as I said, they're going to have to make some new choices they haven't had to make before.
Before I let you go, Francis, the differences in the current state of Canada's economy and the U.S. economy are making the way through the markets because there is this. Even this morning, we saw some data that would suggest perhaps there's a justification for the U.S. Federal Reserve sticking with higher rates for longer. Can you give us your own expectations on the Fed's path and how that compares to the Bank of Canada?
We also think the Fed is done hiking interest rates, which will give a little bit of pressure off the Bank of Canada as they do remain mindful of those considerations. But in the United States, they have less debt. They have 30-year fixed mortgages. Imagine if you got to lock in at 2.6% for 30 years on your mortgage, how different your life might be right now. But we do expect the U.S. will also experience a recession or something very close to a recession, but later, more shallower and shorter than the Canadian experience. And that's just the structure of our debt markets and how our economy is much more leveraged towards debt. Therefore, 25 basis points of interest rate hikes in Canada hurts a lot more than it does in the United States. We're going to see that in the next year.
Francis.